Good morning, everyone. It's Wednesday, the 14th of December, 2016. It's 8:02 a.m. Chicago time, coming at you from Chicago's financial district downtown. Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. My brain's a little sluggish this morning. It's about 5 degrees Fahrenheit outside. That's negative something or other in Celsius. It's very, very cold. Let's take a quick look at the overnight news. Overall, the market is standing by for what is the biggest day of the week today. We'll go over the calendar in a bit, but the market's expecting the FOMC to announce today, and the overwhelming bias is to raise rates. That it'll raise rates. This morning we got several things out of Europe. UK unemployment holds at a 10-year low, showing unemployment rate at 4.8%. Remember yesterday the announcement was that there was some pricing pressure, inflationary pressure, which is good. And of course the Dow's closing in on 20,000. We finished Tuesday at 19,904.46. This was the 16th record high since election night yesterday. Other than that, Spain is making moves to take business away from London by accepting documents in English and fast tracking companies that are moving from London to the Eurozone, and it's also promising that it will not impose any regulatory requirements above and beyond what the EU requires as a whole. So that's a great move by them. And then this morning we got a slew of numbers here. We got November advanced retail sales disappointed at 0.1% versus 0.3 expected. Retail sales ex autos came in also disappointing, 0.2 versus 0.4. And November PPI, producer price index, final demand month on month came in at 0.4, better than 0.1 expected, and year on year 1.3 versus 0.9. Looking ahead today, we have industrial production in about 10 minutes, and cap utilization industrial production month on month for November expected at negative 0.2%. Cap utilization is expected at 75.1 capacity utilization in the U.S. for November. And then we're at 10 o'clock, we're looking for business inventories for October, negative 0.1%. That could be a market mover. And then following that at 10:30, we got the weekly crude oil inventories, distillates, and gasoline. Crude oil inventories expected at negative 1.5 million barrels to be reported. Last week we had negative 2.389. Distillate inventories overstock of 1 million barrels. Gasoline inventories expected overstock of 2 million barrels. And then at 2 o'clock Eastern, 1 Central, we're looking for the FOMC announcement and looking for a rate change, a rate increase of 25 basis points, which triggers off the raising cycle. And then at 2:30, we'll have the press conference with Fed Chair Janet Yellen. Also at 2 o'clock, President-elect Trump meets with technology leaders. It includes Apple, Google, Tesla. All these guys are meeting with our new president. Not sure if anything will be tweeted out before that, but we'll see. That's about what's on deck today. Let's take a look at what we expected yesterday. The primary idea yesterday during the Trader Bite, we had the market trading at near highs, near Monday's highs at 2258, 2259. And the primary expectation, given the way the market was shaped yesterday, because inventory was on the buy side, We were looking for a small drop early, and then a rotation up, and for it to continue higher into 2264 quarter and through. That's the primary hypothesis. Bullish. Remember, the whole idea behind the hypo is what we can lean against, identifying areas we can lean against, identifying the major direction to trade with, and then identifying the targets that we're likely to take trades off at after we get in. The secondary hypothesis is a quick burst up, a rotation back towards the prior day's range, but holding steady and finishing somewhere above the prior day's range. That's hypo 2. Hypo 3 is a push higher, failing to find continued buyers, finds sellers, rotates down, and comes right back into line to 2252. Hypo 2 was the dominant theme, except that yesterday what it did is we immediately burst uh, into an open drive right off the get-go. We never rotated below and into the range. We just ticked down. So we opened, we ticked down, and then we pushed right up. That was an open drive. You can argue it was an OTD because of the small rotation down. And then that fizzled out at 67.75. Remember, our first target was 64 and a quarter. It just blew right through it, fizzled out, and it came right back towards the prior day's range, and then drifted up. So that what that looks like is hypo 2, except it moved up. So if you took this whole thing with hypo 2, oops, if you took this whole thing with hypo 2 and shifted it up here, had it open up here, you would have basically the same sort of thing where it just tests lower and then finishes higher. So still very bullish. We're still one time framing up on the daily. So when we look at a bigger time frame here, we'll see that. Hang on, let's minimize this. When we look at the bigger time frame, we still see continued trend up. So this is right here is the daily RTH only. We continue to see one time framing up, lower, higher lows, all the way through higher lows. There's no sign of buyers abating yet. There was a comment yesterday by a fund manager. Not that I don't give these any weight, but I find it interesting, especially if it's based on history. It says Jeff Gundlach said during a webcast titled "Drain the Swamp" that the Double Line Funds manager founder says stocks typically rise following an election and then sell off as investors realize the new president can't implement everything he has promised. I find that, I don't know, it doesn't give very much credit to investors. I mean, if you've been doing this a while, you kind of know what presidents can and cannot do. So I don't see. I know there are a lot of bears. There's just a ton of articles out there saying, this is going to get ugly. The big bear's coming out, and so on. I just want to caution you to make sure you're trading your own time frame. These articles are written for a general audience, and a big part of that audience is institutional, is the OTF. And to them, something that is going to happen soon could be 6 months from now, or a year from now, or 2 years from now. Whereas to us, something happening soon means today, in today's trading at some point. So whenever you're reading something about the market crashing and is overpriced and imminently, imminently going into a bear market, always question the time frame that the author's using to discuss. Here's what last night looked like. So overall, we opened and we held a line below yesterday's the prior day's value. The prior day's value. Overall, it's just What is going on here? Hang on. Something is going on. Not sure what's up here. This is the wrong chart. It doesn't look like anything like the chart I had this morning. So let's switch this to the overnight. Just switching this to actually a 24-hour chart so we can see what the overnight did. The overnight actually rallied higher. It did not ignore those comments. So here it is. The overnight session. Man, what is going on here? Looks like my data is dead. Technical issues in yesterday's webinar and today's. Not sure what's happening here. Give me a second. I think my data might have stopped here between doing homework last night and starting it today. Sorry about this. Get this taken care of. This should catch up here in a second. There we go. The troops are coming. And yep, it's pulling the data in now. But overall, the overnight trade, the overnight trade, well, it's currently trading at 22.64. We're going to find out here in a second how high up the market went. If somebody has that the overnight high, let me know. I don't have a clue where it is at the moment. So this data is loading. Unfortunately, this is kind of putting a damper on things. Here it is, 22. What do we have? 22.6875 is the overnight. Is that correct? I'm doubting my data now. Yeah, okay. So let's take a look again at the overnight chart. So 22.6875, very quiet overnight session. And the reason, of course, is the, okay, that's what I thought. Here we go. The overnight just held right inside of the prior day's value. That's why I was confused by the prior chart on the 27th. It looked very, very similar. It held the value high of the prior day and sat sideways. And the reason it sat sideways is because of the FOMC. We do have rollover happening at the same time as the FOMC. So the overnight volumes at 111,000 is still pretty high for a day like today. We still have folks rolling into the March contract from December, and that's why it's high. The volume picks up quite a bit during rollover. But overall, the market has nothing to say about the overnight session except that it's accepting yesterday's pricing and it's trading within it. So there's not much we can glean from the overnight session other than we have a weak high, a double top on the overnight, and it's moving the other way, pushing lows. So we're looking for value low from yesterday to be tested here by the open. This morning, the expectation, knowing that we have the FOMC coming up, it's likely to be quite muted. The expectation is for a push higher towards that 68.75, and I'm looking for it to balance. And then at some point we get FOMC, but I'm expecting it to not go anywhere until the FOMC kicks in. The FOMC is always I'm going to look for a three-wave pattern. I'm going to look for the market to drop, pull back, and then continue to drop, or rise, pull back, continue to rise, and I'm looking to catch the third wave of the announcement. So it's hard to identify in real time, but it becomes obvious once wave 1 and 2 are done. But in general, the market doesn't drop and just continue up or down. It pushes, pulls, and then finally pushes in the opposite direction. And the reason, there are several reasons for that. I won't get into that now, but it has to do with not only taking a position on the announcement, but also hedging positions in other areas by selling futures opposite to long positions that you have, and so on and so forth. So the primary hypothesis, as I said, is for responsive buying up, looking for it to test higher, pull back, and then just hold sideways. That's our first hypo. And then we're going to be looking for the FOMC. And then from the FOMC onwards, we would have to use this morning's information to decide at that point how things are likely to look like into the close. The secondary hypothesis, less likely, is for it to drop early, find a base, come back to value high, and also hold somewhere in the middle. So it's either I'm looking for to trade from the outside in today. So I'm looking to fade any moves away from value. As we move away from value, we're opening in balance. So I'm going to be looking for any moves away from here to trade against. Those of you who attended yesterday's webinar probably saw how I'm using the order book, and how participants in the book are moving around in the order book are moving around to trade against, and so on. By the way, I'm fixing that video. I'm re-recording it because of the technical issues we had. I'm re-recording it, and you'll have a clean copy to watch once it's released. I suggest you go into the description of this video and this stream and join the newsletter. There's no spam. I don't send spam out. Join the newsletter to get a copy of that recording, and it discusses, you know, locating entries using order flow. So you have hypo 1, 2. I don't have hypo 3. This is an FOMC day, along with crude oil, business inventories, a lot going on today. Just keep your powder dry. Make sure you stay in the game until the FOMC comes. There's likely to be more opportunity there. Good luck, and I will catch you tomorrow. Take care.